Alphabet, the parent company of Google, just reported earnings and they crushed it. Revenue came in at $96.4 billion for the quarter, beating analyst estimates by 9.65%. And non-GAAP earnings per share came in at $2.31, beating analyst estimates by 6.94%. Despite those good results, Alphabet sold off nearly 2.3% after hours. However, it has since rallied up around 1.7%. And I think a big reason for that initial sell-off is that over the past month, Alphabet stock has gone up over 15%. In fact, from July 8th to July 22nd, the stock went up every single day. And this is because Google is a leading AI company and one of the best big tech companies in the world. This company has a core cash cow business model in digital advertising around Google Search and YouTube, plus a fast-growing cloud business that is accelerating and becoming increasingly more profitable. Oh, and did I mention this is one of the leading AI companies in the world? And you can make a strong argument they are the leader. And they certainly are spending like it. And that's where we get to the only short-term negative for Alphabet stock, and that's the massive CapEx spending, which is now increasing again, hurting their short-term free cash flow. And today I will explain whether or not I think this is a good or bad thing for Alphabet stock investors. Plus, I'll give you a full deep dive into their latest earnings report, share a look at my position in Alphabet stock, which was my #1 buy of 2025, and I loaded up during that April tariff sell-off. So I'll give you a full update on how that has performed, my expectations going forward, and what prices I'll be looking to buy more Alphabet stock myself. With that said, let's roll the intro and jump into this Google stock update. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using the best stock research tool, dividenddata.com. The link is in the description and pinned comment of the video. Speaking of that, let's jump right into it, and I'm using our AI analyst to summarize the latest earnings report for Alphabet. So here you can see that revenue was up 14% year over year, which is an acceleration from the growth year over year in Q1 2025. It went from 12 to 14%. Google Services revenue, which includes all their digital advertising businesses, whether it's Google Search, YouTube ads, or their display ads on websites. That also includes their subscription products, whether it's YouTube Premium or their new Google Premium with all their AI stuff in it. That is up 12% year over year at $82.5 billion. So this is by far their largest business segment. And of that, Search and YouTube are the biggest. We'll talk about that later. So growth is accelerating here from up 10% year over year in Q1 to up 12% year over year in Q2. And Google Cloud, which is strategically very important and a big growth business of the future for them, that came in at $13.6 billion, up 32% year over year. So again, growth is accelerating in Google Cloud from 28% last quarter to 32% in the latest quarter. And in both Q1 and Q2, they crushed earnings per share. Last quarter, they had a big outlier to the upside at $2.81. That was a huge beat. That was 49% growth year over year. This quarter, they came in at $2.31, which was still great performance, up 22% year over year. And as we look at the stock analysis tool to see the quarterly earnings per share, it hasn't updated yet with the latest earnings per share data for Q2, but you can see it's still this big trend of growth. And here's the big news for this quarter. One around AI and CapEx, and they're relating. The CEO, Sundar Pichai, emphasized that AI is positively impacting every single part of their business, and each vital segment is seeing double-digit growth. That's Google Search, YouTube, subscriptions, and Google Cloud. So you hear, oh, Google Search is dying. It's not. The numbers are showing that it's continuing to grow at a high rate, and AI overviews are being integrated into Google Search, and there's now AI mode in Google Search. Those are seeing incredible usage, and over time, my assumption is that they will see advertising rolled into those products, and they probably will be the best monetized free AI. We're not there yet, though. That's probably a few years away. And because this is a leading AI company and they actually build out the data centers themselves, the flip side of that coin is that their CapEx spending is massive, and they are actually increasing their CapEx in 2025 to approximately $85 billion. And that is to support their strong and growing demand for their cloud products and services. Let me say that again, $85 billion. That's a lot of money. And that's why free cash flow for the latest quarter only came in at $5.3 billion, which is down 61% year over year. And the reason is their quarterly capex went from $13 billion in Q2 2024 to $22.4 billion. And that's only growing. So Google is an interesting company right now where they are growing very well and they're one of the leading AI companies. But in order to keep that position and fund all this future growth, of which there may be a gigantic money bag at the end of it, they are spending more and more money every single quarter. And that's only going to go up and probably keep increasing for the foreseeable years to come. And there are only a few companies in the world that can even afford to get into this game. It's Alphabet, it's Meta, it's maybe XAI with Elon funding it. OpenAI, even though they've raised a ton of money, they're going to struggle to keep up this level of spending. And then in the cloud game, Microsoft and Amazon, they're going to continue funding it as well. So if you're interested in tech and business, this is a very interesting environment to pay attention to. And the big question around this large CapEx spending is whether or not it pays off and how long it takes. And before I get into my analysis around that and how I value Google stock going forward, let's do a little bit more update around their business segments and how they're growing. Google Search came in at $54.19 billion. That's up 12% year over year. So this is a huge business, their largest and most profitable business segment by far, and it's still growing. YouTube ads came in at $9.7 billion, which is up 13% year over year. YouTube is going to be a fantastic business for decades to come. They also have their Google network, which is the display ads that people put on websites. That's pretty much a flat business right now, and it hasn't been a big growth business really for many years at this point. That was at negative 1% year over year. Still highly profitable, and it leverages the entire advertising network they have built out around YouTube ads and Google Search. And this brings up another key kind of risk around investing in Alphabet. So much of their revenue is advertising dependent. So how they do at any time really depends on how the economy and ad spend is at that time. Now, luckily for them, digital ads are the best way to advertise in the modern age. So that's why you see Google and Meta being the main advertising sources. But we have seen markets in the past where ad spend declines, like 2022 when we were in a little bit of a recession, and you saw their earnings per share decline in that time, and the stock price fell off significantly. The same thing happened over at Meta. They saw an even sharper decline in earnings per share, and the stock sold off massive. However, that was a great buying opportunity, and I wish I was loading up on this stock then because it crushed it. And Meta is in a fantastic position going forward as well. But this is part of the reason why Alphabet and Meta, even though they're such dominant companies, they tend to trade at slightly lower multiples than a company like Microsoft, where the overwhelming amount of their revenue is subscription recurring revenue. Microsoft's much more reliable than these advertising-focused companies. But that's why you see an increased focus on subscription revenue at Google. As an example, in the latest quarter, that is up to $11.2 billion, up 20% year over year. So this is the fastest growing part of their Google Services revenue. Aside from Google Services, they have Google Cloud, and that is growing fantastic. As you can see, their year over year growth was 32%. And what I mentioned earlier about their profitability, this used to be an unprofitable segment for a long time. I think it was only about a year and a half ago where it finally turned profitable. And year over year, that has grown from $1.1 billion to $2.8 billion this quarter. And a lot of this revenue is also recurring subscriptions and usage-based. So it's much more reliable than advertising revenue. And that has grown a massive amount. And the operating margin for Google Cloud is expanding. Over the long term, this will become an increasingly profitable part of their business. That said, their $2.8 billion is next to nothing compared to the $33 billion that Google Services generates in operating income in one quarter. And I think it's really important you take this in when you're thinking about it. This is one of the most profitable businesses ever. It's really impressive. But the question really is whether they can continue growing going forward, and whether or not right now is still an attractive price to buy into Google stock. And I think you can make the argument that yes, it still is. Based on earnings per share over the trailing 12 months, the P/E ratio is 21, and analyst expectations for earnings per share growth, and analysts are expecting double-digit earnings per share growth in the coming years, sometimes 20% a year. And that's factoring in a potential weak 2026. And it's probably sometime in there they may see a down year if advertising revenue declines. But frankly, I would look at that as a buying opportunity. If they hit these estimates, then 2029, they will have an estimated earnings per share of $16.29. And based on today's stock price, after going up 15% in the past month, that would be an 11.6p ratio. So we're talking about a wildly profitable company with a great balance sheet and a dominant market position and one of the leaders in the largest growth categories of the future. They're trading at an 11p ratio based on 2029 earnings and 19.7 based on forward-looking earnings. So yes, the stock has gone up a bunch, but it's still kind of cheap. But that is really based on their earnings, and it's not taking into account the massive amount of free cash flow that they are losing from their increased capex. If we do a discounted cash flow valuation on the company, and you can do this in the AI Analyst on dividenddata.com, just type in any stock and DCF valuation. It will do an automated one, but if you scroll down over here and click Show More, then you can open up this calculator where you can edit the assumptions and do your own calculation. And I already updated it to include the $85 billion in fiscal 2025 of CapEx, and then ramping up to $100 billion, $110, $120, and $130 billion in 2029. And if we only assume 10% revenue growth each year and assume the company will trade at a 30 times free cash flow multiple, that gives it an implied share price of $109. And that's because if you're valuing the company based on their free cash flow generated, then if they're spending all of that money away into data center infrastructure, that's not a good return for investors, at least immediately. And that's less money that could go into share buybacks and dividends. So if you're valuing the company based on the free cash flow that's generating in the next few years, that's why Google stock could be depressed. But that could be a buying opportunity if they stabilize CapEx in the future and AI brings massive growth. As an example, let's say they have 15% revenue growth each year, then we're already up to $130 billion in implied share price. But I'll scroll down and show you how much the CapEx calculation matters. So let's say they go to $85 billion and then they stabilize around $100 billion through 2029. That's $100 billion a year. Still a massive amount of CapEx, up from their pre-AI increased spend of $31 billion a year. And again, we'll assume the same 30 times free cash flow multiple. And if we assume that, then the implied share price of Google, $232 a share. That's 21% upside from here. And that's really the game with valuing Google stock. How much is the future growth going to be? How much are they going to be spending in CapEx? And that's really the game from the investor perspective. And that's why with my personal Google investment, I try to be on the conservative end with the buys. I don't chase it up. My cost per share is $161.84. I built this up during 2025, and the overwhelming amount of that was bought during the April tariff crash. And I thought I had a really great margin of safety with those buys, so I just loaded up a bunch of cash. I spent around $25,000 on the stock, and so far I have a 17.5% return. And I'm planning to hold this as a core position of mine well into the future. And I'm not buying more Google stock right now, but believe me, if there's a advertising crash and there's a sell-off, or if there's just a sell-off because there's newfound fears of Google search declining and there's no reality of it declining, then I'll be buying the stock. But right now I'm just holding and enjoying the roller coaster. If you want to track your portfolio and research stocks just like me, then head over to dividenddata.com. It's the best research tool for long-term investors. And if you want to see my stock analysis again in the future and updates to my own personal dividend growth stock portfolio, subscribe to the channel and stay tuned because I'll have a lot more videos on the way. Thank you for watching, and I'll see you in the next one.